Warren, your obsession with Hollywood is starting to worry me.
Well, Mr. B, I look forward to serving as your number 2.
Well, actually, I already have a number 2. Meet Charlie, my Dwight.
You don't look so tough.
Well, actually, there are 18 ways I could kill you right now.
Charlie, have you seen the new trailer for Iron Man 3? It's really amazing.
Iron who?
Charlie will get on his knees for you.
Charlie?
It's done.
Slick, yo. Brittle, bitches.
Charlie, Charlie, I'm so used to I had actually checked myself a couple times already, but
The Berkshire Hathaway annual meeting, often called the Woodstock for Capitalists, is where investors from all over the world gather to hear from Warren Buffett and Charlie Munger. They answer questions about investing, the economy, and their company, providing valuable insights. For the past week, I have been conducting research to find the most valuable information on investing that has been discussed at these meetings over the past 10 years. I looked through a lot of questions and answers and came up with the 5 best ones that give the best advice for people who want to improve their investment strategy, especially for those who do not have a lot of money to invest. Let's jump into the first question. Pay close attention to it because it sums up Warren Buffett's whole investment philosophy.
Good morning, Mr. Buffett and Mr. Munger. Mr. Buffett, I wanted to ask you this question last week when I ran into you after Gillette's annual meeting, but I choked. So now there's no pressure, here goes. In the years, from my reading, in the years from 1956 through 69, you achieved the best results of your career quantitative, 29% annually against only 7% for the Dow. Your approach then was different than now. You looked for lots of undervalued stock with less attention to competitive advantage or favorable economics and sold them rather quickly. As your capital base grew, you switched your approach to buying undervalued excellent companies with favorable long-term economics. My question is, if you're investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future.
The next part of the answer is very important because it is where Buffett explains why he would choose this particular strategy.
If I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But that I was working with a tiny, tiny, tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money with exactly the same background that Charlie and I have, same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. There's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money.
Now you understand how Buffett would put small amounts of money to work. The next question is even more interesting. It will teach you how to get a 50% return every year with an investment of less than $1 million.
Towards the end of 2018, you mentioned that you guarantee you could make a 50% annual return if you had to start again with under $1 million. The question is, if tomorrow you woke up in the body of
Your body.
20-year-old
Yeah,
American.
your body. But that's fine.
And your name was now Warren a la carte. And you had some money to invest on a full-time basis. What method or methods would you use to achieve that return? Would it involve flipping through 20,000 pages of Moody's manual or similar publications, or finding, to find cigarettes? Or would it be hunting for great companies at a fair price, as Mr. Munger would? Or would it be a combination of both, with opportunity cost serving as the final arbiter of which method to use, given that your investing opportunity has now...
The answer would be, in my particular case, it would be going through the 20,000 pages. And since we were talking about railroads, I went through the Moody's Transportation Manual a couple of times. That was 1,500 or 2,000 pages, or probably 1,500 pages. And I found all kinds of interesting things when I was 50 or when I was 20 or 21. And I don't imagine there's anybody here that knows about the Green Bay and Western Railroad Company, but there were hundreds and hundreds of railroad companies, and I like to read about every one of them. The Green Bay and Western, in those days, everybody had a nickname for railroads. I mean, that was just what Northern Pacific was, the Nipper, and Phoebe Snow was one of them in the east that used to go up to Cornell, and the Green Bay and Western was known as grab baggage and walk, and GB&W, and they had a bond that was actually the common stock, and they had a common stock that was actually a bond. And, that could lead to unusual things. But they wouldn't lead to unusual things that would work for you with many millions of dollars. But if you collected a whole bunch of those, which I set out to do, and actually that's what impressed Charlie when I first met him, because I knew all the details of all these little companies on the West Coast that he thought I would never have heard of. But I knew about the Los Angeles Athletic Club or whatever it might be. And he thought he was the only one that knew about that. And that became an instant point of connection. So to answer your question, I don't know what the equivalent of Moody's manuals or anything would be now, but I would try and know everything about everything small. And I would find something, and with $1 million you could earn 50% a year. But you have to be in love with the subject. You can't just be in love with the money. You really got to just find it essentially like, people find other things in other fields because they just love looking.
See, he emphasized 2 points that are very important for everyone. One is to become a learner. As he stated, I would try to learn everything about everything. Why? Well, the answer is the second point, where he stressed the importance of doing something you love and are naturally drawn to. And if you know everything there is to know about the subject of your interest, you will know exactly where to put your money. Here is another question about how to start finding great opportunities in today's world. It is amazing how simple the answer is and how easy to implement by anyone. Here it is.
My question is how to best emulate your success in building your circle of competence. Given the environment today in investing is a lot more competitive than when you started out, what would you do differently, if anything at all, when building your circle? Would you still build a very broad generalist framework, or would you build a much deeper but narrower focus, say on industries, markets, or even a country? And if so, which ones would interest you? Thank you.
Yeah, well, you're right. It is much more competitive now than when I started. And you would, when I started, I literally could take the Moody's Industrial Manual, the Moody's Banks and Financial Manual, and I could go through page by page and at least run my eyes over every company and think about which ones I might think more about. It's important. I would just do a whole lot of reading. I'd try and learn as much as I could about as many businesses, and I would try to figure out which ones I really had some important knowledge and understanding that was probably different than overwhelmingly most of my competitors, and I would also try and figure out which ones I didn't understand. And I would focus on having as big a circle as I could have, and also focus on being as realistic as I could about where the perimeters of my circle of competence were. I knew when I met Lorimer Davidson in January of 1951, I could get insurance. I mean, what he said made so much sense to me in the 3 or 4 hours I spent with him on that Saturday. So I dug into it, and I could understand it. My mind worked well in that respect. I didn't think I could understand retailing. All I'd done was work for the same grocery store that Charlie had, and neither one of us learned that much about retailing, except it was harder work than we liked. And you've got to do the same thing, and you've got way more competition now. But if you get to know even about a relatively small area more than other people do, and you don't feel the compulsion to act too often, you just wait till the odds are strongly in your favor. It's still a very interesting game. It's harder than it used to be. Charlie?
Well, I think the right strategy for the great mass of humanity is to specialize. Nobody wants to go to a doctor that's half proctologist and half dentist, you know. So the ordinary way to succeed is to narrowly specialize. Warren and I really didn't do that, and we didn't because we prefer the other type of activity. But I don't think we can recommend it to other people.
Yeah, it was a little more treasure hunting in our day, and it was easy to spot the treasure.
We made it work, but it was kind of a lucky thing.
Yeah.
It's not the standard way to go.
The business, at least I best understood, actually was insurance. I mean, and I had very little competition.
Now let's move on to the next question to learn about the benefits of having small investment capital in identifying investment opportunities for those with lower dollar thresholds.
You've repeatedly said that you see many wonderful stock ideas but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold,
do these stocks have names?
well said.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than $100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, you know, I've got this wonderful thing, and I usually know ahead of time, but I mean, I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money that there almost always are some significant inefficiencies, some fine thing. I've mentioned to some people, when I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked. You could find out about them, but nobody was going to tell you. And my guess that continues to be true, but not on anything like the scale.
As we learn with that question, Buffett claims that he can achieve a 50% annual return if he starts over with an investment of less than $1 million. But if you are like me wondering how to achieve high returns with a small amount of capital, the next question needs our attention.
Said that if you had just $1 million to invest now, you could achieve returns of 50% per year.
We can't do with our present resources what we did want. There are a lot of things I can't do that I used to do better.
Yeah, well, you can confess to those, Charlie. Well, but I think he may be driving at the point that have we learned things in managing since we were at that level where we could do even better with $1 million now than we could have done with $1 million then? And I would say the answer to that is yes.
Yeah, I think that's true. There's enough craziness out there. If you have endless time and only a very small amount of money, I think find ways to do pretty well.
And in the course of 50 or so years, we have probably learned more or been exposed to more that if we were back at the $1 million level, we would know more places to look, I think.
Well, I say what's interesting about Berkshire, and many of you have been around for so long, you've actually seen it happen. Berkshire's record would have been terrible compared to the way it turned out if Warren hadn't kept learning all the way. Each decade, to make the record decent, he had to learn to do some things he didn't know how to do at the start of the decade. And I think that's pretty much the human condition. Of course, he's getting old. I worry about him a lot.
I'll resist commenting.
If you found this video interesting and want to learn more about which 3 investments recommended by Buffett have created the most millionaires and continue to do so, watch this video right here.